Hey fellow traders, and welcome back to Market Analysis with Richard from NGT. In today's video, we will be discussing early entry and how it is vital to getting the right trades. So without further ado, let's begin. Early entry is the missing puzzle piece in a lot of Forex traders' analysis. So I will lay out the facts. If you have a late entry into a trade, first of all, you are required to set a wider stop loss to accommodate your late entry into the trade, and also that means you will risk more. Fact number two, if you have a late entry, that means your lot size will be smaller to have room for your wide stop loss. And you probably cannot achieve your 1 to 2 risk reward ratio goal because it is easier to take a trade with 25 pip stop loss and aim for 50 pip take profit than to take a 50 pip stop loss and 100 pip take profit. You might not get the 100 pip move as often as the 50 pip move. So you'll find yourself making lousy trading decisions. So let's go over a live example of a late entry. Say you identified this trade and you notice that it made the first leg, then it made a pullback, and then it made a continuation move, took out the low of the initial pullback. And on the close of this bar, you sold into this trade for whatever reason. It continues in your direction. You're feeling very confident. You're feeling very happy. You're feeling like you're the best trader in the world. And you expect it to go further. So what happens is it makes the pullback, right? And takes you about back to break even because it's at the close of this bar. So about back to break even or a little bit negative. And you jump out the trade. That is the example of late entry. You will just get out the trade. So if you don't realize that late entry is a thing and it gets us all at some point and at some time. It's like a really great trade. It might look like a really nice setup. And just because you got in late, first of all, you have to set a wide stop loss, about 95 pips or so. And then you have to set a 1 to 2 risk to reward ratio. That'd be 180. And it did not reach that 1 to 2. So it would have gave you about a 1 to 1.9. So first of all, you mess up your risk to reward ratio and you just get out at break even, and you would mess up this very nice trade. So that was an example of late entry. Our goal here at NGT is to give you only the information that you need. And I can't stress this enough, your risk to reward ratio is the most important component to lucrative trading. So to learn more on risk management, check out our risk management video. A link will be in the description for you. Fact number 3, emotion and mindset. If you don't have those two other components, your philosophical reasoning will be not so good. Emotion is involved in everything you or anyone else does in trading, regardless of what. So that's why it is so important to build a backbone in trading, to create your reference point and work based off of that. There is 3 things you have to keep in mind. 1, Have a precise, ready-to-trade mindset in order to pick out the best trades. 2. Have a good risk-to-reward ratio to avoid stressing over trades like when you are over-leveraged. And 3. A great trade plan for entry and exit. It is important to know how to get in, but it is even more important to know where to get out. There is no such thing as a unemotional trader. So if you take an erratic position and end up having a losing trade, it should not impact you at all if you're following the right risk to reward ratio. So you can confidently trade. So to summarize, early entry means good risk to reward. Good risk to reward means a wonderful mindset, and a wonderful mindset means happy trading. I hope you enjoyed this video. I hope this video helped, and I hope to see you in our next